What's going on, guys? My name is Grant Warfield and I'm a CPA candidate. Today, I'm going to show you exactly how accountants think about expenses. Let's get into it. Alrighty, friends, let us waste no time. Today, I'm going to cover exactly how accountants think about expenses. And I know what you're probably thinking. Grant, I know what expenses are, but if you stick with me throughout this video, I'm going to show you how to approach expenses as a certified public accountant would, right? So let's dive into it. As you know, I usually start with the common misconception. I dispel that myth, and then I give you some formal structure. So people typically think about expenses as money going out. Okay, that's how lay people think about expenses, right? And there's nothing wrong with being a lay person, but if you want to be an astute capital allocator, you're going to need to add some rigor to your definition of an expense, okay? So if expenses were just money going out, then every cash payment would be an expense. But that's simply not the case. Purchasing equipment is not an expense. Paying down loan principal is not an expense. And prepaying for insurance isn't an expense either. And when I say it's not an expense, I'm speaking to this strictly from a GAAP perspective. And GAAP stands for Generally Accepted Accounting Principles, okay? So every public company that is currently issuing their financial statements to the public has to adhere to generally accepted accounting principles. That's just the standard. So if you really want to think deeply about financial matters, you want to approach accounting matters from a GAAP perspective, and that's exactly what I'm going to teach in this video. So now that we got the beginning over, let's go through a formal definition of exactly what an expense is. An expense represents a decrease in equity. Okay, and if you watch my other video on revenue, you would know that revenue represents an increase in equity. So expense is going to be the inverse, right? So expense is going to decrease equity, and this is going to be caused by the consumption of an asset. Okay, and what are assets? Assets are probable future economic benefits. And I want to really hone in on the fact that they are simply probable, meaning they're not definite, right? We haven't realized this value. We strongly believe that we will. Okay, that's the formal definition of an asset. Okay, now let's take it from the top. So an expense represents a decrease in equity caused by the consumption of an asset or the incurrence of a liability. And a liability is simply a present obligation. In the process of generating revenue, and I'm going to underline this whole section right here because it is core to what an expense actually is. You guys know me, I'm a big formal structure guy, so let's go ahead and map out how this actually works mechanically. So we have net income. To derive net income, we're going to take revenue and we're going to subtract expenses, okay? So when expenses go up, net income is going to go down. Net income represents the earnings of the firm. In order to derive retained earnings, we're going to subtract any distributions to owners, okay? And these are going to be called dividends. And this is going to yield us retained earnings. Retained earnings is a component of equity. So if retained earnings goes down, equity is going to go down as well. Okay, super simple, logical flow. So let's run through a couple examples to really make these points clear. So in this first example, we had a cash expense. We paid rent for $1,000, okay? So what's going to happen to our beloved accounting equation? And if you're not aware of what the accounting equation is, it's simply assets equals liabilities plus equity. Okay? Assets represent resources. Liabilities represent external claims on those resources. Equity represents owner claims on these resources. Okay? So we had a cash expense. We paid rent of $1,000. So naturally, cash, which is an asset, is going to decrease. This value has to come from somewhere. So in this case, we had a cash expense. That's going to come from the pocket of the business owner. So equity is going to decrease. Okay? So cash goes down, retained earnings goes down. Okay, in this next example, we have an accrued expense. And just for your awareness, accrual accounting is a system of accounting whereby we recognize revenue when it's earned, not necessarily when we're paid or when we receive cash. And we recognize expenses when they are incurred, okay, not necessarily when we pay for them. So this is a perfect example of an accrued expense. So wages were incurred, but not yet paid, meaning our employees have performed work for us. Okay, so they have earned this income, but we haven't paid them yet. But we must accrue for this because we want to recognize the fact that they've earned it, therefore we have incurred an expense. So an accrued expense is considered a liability, okay? It's a present obligation that's going to require us to transfer assets or resources in the future. So liabilities are going to increase in this scenario. And of course, this money must come from somewhere, so it's going to result in a reduction of equity, okay? Because it's coming out of the business owner's pocket. The technical name for the liability account that's going to increase is going to be wages payable, okay? And then we're going to see a reduction in retained earnings. Now on to depreciation, which is a fairly interesting accounting topic. So depreciation is interesting because it's what's considered a non-cash expense. Now, I know what you're probably thinking. Grant, how in the world can an expense not result in the consumption of cash? Well, allow me to explain. Depreciation is what businesses record to recognize the progressive consumption of value. Okay? And to make this concrete, let me give you an example. Let's say you buy a car in 2010. We now fast forward to 2020. Is that car going to be in the same exact condition? Of course not. Okay, you've used it. The brakes probably aren't as sharp as they were. The engine might not be up to par. So you already have an intuitive understanding of depreciation. Accountants just use this mechanism to recognize the consumption of value over time. It's just what's called an accounting allocation. Okay, so as I stated, no cash is moving, but some accountant way back when said, how can we recognize the economic phenomena whereby equipment or things, okay, because everything degrades over time, whereby things degrade over time. And they came up with depreciation as it relates to tangible equipment or assets, we should say. And there's such thing as an intangible asset. For those, we record amortization, but that's beyond the scope of this video. Just know that depreciation is a non-cash expense. It's considered an accounting allocation, and it simply represents the consumption of value over time. Okay, so when we record depreciation, assets are going to go down, and of course, this value has to come from somewhere, and it's going to come from the business owner's pocket. Okay. And to put some account names along with these examples, so let's say, for example, we have equipment, okay, that is a tangible asset, and we want to record depreciation. We're going to record depreciation on that account via a balance sheet account called accumulated depreciation. All you need to know about accumulated depreciation is that it is a contra asset account. Meaning, whereas assets have a debit balance, okay, a contra asset is going to have a credit balance, okay? It's going to be the inverse. And of course, we're going to recognize a corresponding decrease in retained earnings. And this is why expenses don't always equal an outflow of cash. Now it is time to briefly cover the concept of capitalization. So with capitalization, all you need to know is that with an expense, you could do one of two things. One, you can expense it immediately. Two, you can record it as an asset. That's it. Okay, you have one of two choices. You could either do one or two. Now, when you immediately expense an asset, we're saying that this asset was consumed at once. Okay, we consumed it immediately. Therefore, equity is also going to decrease in turn. Now, when we capitalize a cost, we're going to record an asset. Equity does not decrease yet. Expenses are going to be recognized over time. And this brings us back to the concept of depreciation and amortization. So if we capitalize an asset, we're saying that we expect to receive benefits from this asset over a period of time. And as we consume those benefits, because everything degrades over time, right? We need to recognize the consumption of this value. We're going to record either depreciation for a tangible asset or amortization for an intangible asset to recognize the consumption of value. Alrighty, gang, home stretch here. Just know that expenses are recognized when economic value is consumed to generate revenue, okay? Not necessarily when cash moves. This is why expenses aren't about cash outflows, it's about value being used up in the process of revenue generation. That's all, folks. Really appreciate your time. Thank you so much for watching. Please let me know what you think in the comments. Like, subscribe, stay tuned. Thanks.